Hello, and welcome to the Three Questions Podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital Management. Now, if you or someone close to you is a Canadian homeowner facing a mortgage renewal in 2026 and feeling anxious about higher rates, your cash flow situation, or how this all fits into your retirement plans, stay tuned. Our topic: the three questions Canadian homeowners should ask before renewing their mortgage in 2026. Thank you for taking time to check us out. And if you enjoy this episode of the Three Questions Podcast, please consider liking this video and subscribing to our podcast and YouTube channels. Today, we're exploring the three questions Canadian homeowners should ask before renewing their mortgage in 2026. And joining me once again on the Three Questions Podcast from Langley, British Columbia, is Peggy Shepherd. She is a respected mortgage broker with Invest, Canada's mortgage experts. With years of experience helping Canadian homeowners navigate renewals, refinancing, and rate changes, Peggy specializes in creating mortgage solutions that align with her clients' broader financial and lifestyle goals. Peggy, great to see you again. Thank you for joining the podcast.
Always happy to be of service. Always nice to have a conversation and educate our clients.
Absolutely. And we got folks listening across Canada and the United States here today, Peggy. And I know the topic of mortgage renewals is always something that grabs people's attentions. Remember
Yes.
my former boss, I'll call him, Chris Reynolds, back at IPC, used to tell me, he says, Wayne's clients will drive through a snowstorm to cut their rate or mortgage rate by 0.5%. And so we're going to be dealing with slightly different rate changes than that this time around, but great to have you on the podcast. And before we get to our questions, I want to set the stage for Canadian homeowners right now, especially those in your home province of British Columbia, which I'll tell you right now is one of the most beautiful places in the entire planet. I love British Columbia. I got family there, love visiting there. After years of historically low mortgage rates, many families are staring now at renewals that could significantly increase their monthly payments. And I'm sure you're seeing that as well. What are you seeing with your clients right now and what they're facing going forward?
Absolutely. I've got clients that are coming out of 1.79 and 1.89 interest rate mortgages. And of course, in Canada, we only have a term of, say, 1 to 5 years, 7 or 10, different than the States, United States. And here, when we're renewing, we're looking at the low fours right now. So if you have a $300,000 or $500,000 mortgage, you're looking at quite a difference in payments every month. And this can make the difference in between saving for your retirement or not. It can be, whether about life insurance, property taxes are going up, everything about household ownership at this point is going up. So renewals are really become an important part and discussion that needs to be made, because it's not as if they're increasing $50. You're talking $500, $650 a month change in people's budget. That's quite a bit when you talk about the incomes.
Absolutely right. And at the same time in British Columbia, I know just generally speaking about this, but I mean, it was brought to my attention just recently, and I'm picking on you because you're in British Columbia, so note that.
That's it.
There are recent developments in British Columbia regarding Indigenous land claims that are really raising important questions around property rights and land ownership across the province of British Columbia, and they can affect the future resale values. In BC, I'm more curious than anything. You shake, you flash something shiny in front of me, and I'll just kind of grab onto it. So here we are. But how is that impacting homeowners' decision making going forward when it comes to mortgage renewals? Are you seeing that changing their philosophy or their point of view on their mortgage renewals?
Sorry, the screen just went up. What I'm seeing at this, sorry, I've got something coming up in my system. Yeah. What I'm finding with that, a lot of that is there is some uncertainty, because BC is one of the few provinces in Canada that still has unsettled land claims. And they're in court right now with many of these, and that could drag out for many years. But it is creating a uncertainty, a sense of fear, as you say, spooked, idea and concept for a lot of people that are current homeowners that are not sure if their homes are in those ranges, or for people purchasing, it's also affecting them. Because whenever there's an uncertainty, in what you're actually buying or what you're actually selling, it has a problem, obviously, as the overall values. If, for instance, you have a house currently valued at, say well over $1 million, and then all of a sudden that's impacted by the lands claim, what are your rights? How long will it take you to sell that property? What value will that property have? Or will you even have a right to sell that property or only the house on it? So there's a lot of uncertainty that's causing from that. And when you're dealing with any of that, especially purchasing right now, you need to be dealing really with a good, reputable realtor, one that's going to give you honest advice, talk to you about areas that are safe and not under the claims disputes right now. That's a big thing that you want to do. And when I say reputable, I do mean that. I mean, there's really good realtors, real estate agents out there that are really helpful, open, honest, and everything. But make sure you're really comfortable in asking those questions when you're
Yeah.
dealing with it.
Yeah, and I can say this is a legitimate concern. I was recently introduced to a couple that live on Vancouver Island, and they own a property, I believe, north of $2 million, and they are very concerned and actually considering
Mm.
relocating to the U.S. This is why they get introduced to me because of this. So I guess, as the saying goes, more shall be revealed, Peggy, on that one. But I just quite an interesting situation to deal with. And I know, being in the mortgage business, I knew that you were at least adjacently affected by all of this.
Yeah.
Um,
Currently, it is not affecting renewals because if they can't say yes or no if they don't have that information. And like I said, many of them could be in court for many years yet. We really don't know that, but it's not affecting any renewals in that way currently.
Good to know. Okay, so we're discussing today on the podcast the three questions Canadian homeowners should ask before renewing their mortgage in 2026. Peggy, let's get right to our questions. Let's get right at it. Okay, question number one. We are in the process of renewing our mortgage. What role does our current cash flow have in determining the new mortgage rate and the terms that we can actually qualify for? This is right in your wheelhouse, Peggy. I'll turn it over to you.
Great. Okay. Well, a couple of things you should be asking when you're going for renewal right now. Have you been making your payments on time? Have you had any late payments? Things like that. Banks are using AI now more than they ever did before to
Hmm.
double check clients prior to renewing. And this can affect your borrowing things. So, for instance, it can be that if they're not seeing a good pattern, things like other assets that they have with the banks, credit cards with high usage, lines of credit with higher limits, they could potentially offer you renewal, but it may not be at their lowest rates where you might be looking at saying, oh, I qualify for your best rate. I'm a good long customer. That may no longer be the case. In most cases, if you've made your payments, things are fine, your cash flow is reasonably steady and things like that, just a straight renewal is your best option in that case. And remembering you don't have to stay with your current lender at time of renewal. There's no fee to switch to other lenders to get a better rate. So it is a time that you can control that. Um, that's probably the best things to ask when you're qualifying again or discussing your renewal. How does this rate? Where did this rate come from, and how does it compare to other lenders currently?
So one question I always ask with Canadian clients is for them to look into is ask about the difference between uh, variable with variable expenses when they have variable expenses, like, or they don't have regular income.
Yeah.
So for that, when they don't have, when they have expenses that are, like, not consistent, or they don't have regular paychecks, like typically, like, you would see somebody on a salary,
Mhm.
what kind of documentation or other strategies that you would recommend to deal with that if they're going up for a mortgage renewal?
Yeah. So if they're just doing a straight renewal, they probably won't be asked for, but I have had many lenders now, just finally this year because of AI again, asking for those renewal documents. Always be readily available to provide 2 years average. So a 2 year average of your notice of assessments, your income tax returns. And if you're sole proprietor, make sure that includes your business, or if you own in a corporation, make sure it's 2 years of your corporate income because that's where it's being derived from. In those cases, I usually recommend just going with monthly payments as well, just for, it's one less moving target at that point when your cash flow. So those are things, but be prepared with a 2 year average. So be careful that if your 2 years prior to renewal are fluctuating or you're making a lot of changes tax wise at that particular time, be ready to explain that and to show proof of why and how that worked. to your betterment that you're actually doing it.
You have to show up with your mortgage renewal. You have to have your tax advisor there with you as well. Uh, Our topic today is the three questions Canadian homeowners should ask before renewing their mortgage in 2026. And again, joining us from Langley, British Columbia is Peggy Shepard. She is a highly respected mortgage broker with Invest Canada's mortgage experts. Okay, Peggy, why don't we move on to question number two? I'll be renewing my mortgage in the very near future, and I'm expecting my rate to jump from roughly 1.94% to almost 5%. What are my realistic options now? Well, again, who better to have on the podcast than you for this, Peggy? I'll turn it over to you.
Well, there is options for sure. The If your budget is fine for a payment increase, then be prepared for it. But find out early. Start your renewal process about 6 months in advance, asking questions about things like that. If you've been paying your mortgage payments on accelerated biweekly, that's a really good thing in some ways because you've actually been paying off your mortgage faster than it needs to be. At time of renewal, you can stop that acceleration and go back to what your normal amortization would be. So that can soften the blow by quite a bit on your payment structure. Maybe instead of now you'd be at 18 and a half years, you could stretch that back to 20. And that would just allow you a little bit of flexibility in that cash flow. Also, maybe that's a really good time at that point also to consider blending in some other debts, refinancing to increase your cash flow overall in your home and reduce your debts. And that would also be a nice way to soften it. Also, you could go from accelerated biweekly to just going to monthly. So it would give you more time to smooth out that cash flow. It's not going to change a lot in your payment at the end of the year term, but it will soften the blow currently for your cash flow.
Okay, back, when I was living in Canada and we had a mortgage there, we would always look at, fixed rate versus variable rate. So currently, under the current regime, how do fixed rate versus variable rate products compare, especially for homeowners who are concerned about, any future rate movements?
Well, you've got some good options there. As far as variable, if your cash flow is good and steady and you can handle any fluctuation affordably within your payment structure, then yes, variable rates have often done very well. Currently, they're not as strong as they used to be, but they are still a good option. But you have to be okay with that payment fluctuation. So variable rates can be fine. There's a couple of different kinds of mortgages that might be better in a case like that. You can go variable with a fixed cap payment, meaning that
Interesting.
if it gets to a certain point, it stops there. The only
Interesting.
problem, yeah, the problem with that, well, it can be, it doesn't necessarily have to be, but if it reaches that, you're never going to go above that area. So your payments will stay at that level. But if the interest rates continue to go up, your amortization and behind it isn't getting paid down quite as quickly. So that can be a thing. At this point in time, I'm not seeing massive rapid rate changes in the future. So I think you'd be fairly safe with that, but it would give you sort of a comfort cap, knowing that there's fluctuation, you're still going to be able to afford it. It gives you the benefits of sort of a fixed rate mortgage as far as payment control is.
Right.
But one, you know what your interest rate is on your fixed. The other one, the interest rates will fluctuate.
Just a follow-up to that. You had mentioned earlier about, kind of tweaking the way you pay your mortgage, going from
Mhm.
biweekly to monthly and how so in the US here, as you mentioned earlier, there's, very common to have a 30-year amortization on the mortgage. And in Canada, it's more typically, even though they renew every 5 years, there's a 20-year amortization. I think it's probably more common in Canada than the US. But are you seeing clients come to you asking for 30-year amortizations, or the way they're calculated in Canada, does it make much of a difference? Does it work the same way?
We're similar, but a little bit different to what you're saying there. Typically, our most common mortgage is a 25-year amortization.
Yeah, yeah,
Not
20,
20.
25 years, yes.
Yeah, 25 is typical, and they are extending them to 30 as
So
well.
the
So
people
there's,
are going, and it does make a
yes,
material change. I mean, obviously, it means you're paying more interest and over a longer period of time, but they
it
are
is,
big.
but
People are making that as an option, even though, again, the thing here that for my American friends they find rather interesting is that you can have the amortization over, 20, 25, or even as you mentioned, 30 years, but they have to be renewed. You typically every 5 years. Where here,
that's right.
you can lock into a 30-year mortgage and, like, for the folks here, the clients of mine, friends of mine, they got rates in the low 3% range that, they could keep those in place for the next, 15, 20 years. Don't have to
Yeah, and
renew.
yeah, that isn't the same in Canada. In Canada, of course, you are renewing every so many
Yeah, every
years.
five, usually typically every 5 years.
Yeah,
That's the
typically
difference.
it's 5 years. And when you're doing that, but your amortization can be 25 or it can be 30. The benefit, of course, of that is even if they take the longer amortization to start with, you can always then choose to say, okay, I'm going to take accelerated payments, which means then you're actually making 26 payments a year instead of 24 for the value. So you're paying it down faster anyway. So you can get similar, but it's also for qualifying. If you need to qualify, say your income, you get bonuses or you're expecting an increase or something like that, you can also qualify for a bit more if you amortize it over 30 years for your payments. But then you can make increased payments or bulk payments, throughout the mortgage as well, or increase the payments after.
So
So you can work on
you
both
can
sides.
qualify for a lower payment, but then after the fact, you can expedite the payments
That's
essentially.
right. It
Got it.
helps with
Great.
qualifying. Yeah.
Another thing, just remind me, refresh me. In Canada, mortgages are portable, right? You can, if you have a mortgage on house A and you decide to move, say from Langley, British Columbia to Richmond, British Columbia, and you have a mortgage on one house, you can move that mortgage over to the new property. Is that correct?
That is correct. You can move that. And it's not just within the province, it's almost all throughout Canada. So if
Yeah.
you were in Ontario and you wanted to move to British Columbia or vice versa, or Alberta or Nova Scotia, you could take that mortgage with you. It
Yeah.
typically has to close within 30 days to
Yeah.
transfer it. But it also can help to arrange bridge financing between the homes, things like that. So even if you have a really good low rate and you want to hang on to it, that's how you do it is you port it to the new property. Of course, there's always conditions that can arise that doesn't fit. And if it's a variable rate mortgage, it does have to be moved to a fixed rate. You can't,
Interesting.
yeah, you can't port a variable rate.
Interesting. Well, in the U.S., there's no such thing as portable mortgages. Well, I just my friends listening to this here in the U.S. going, what do you mean portable? Uh,
It is a
all
good
right.
option, and it really eliminates the large penalties that could apply.
Yeah, well, see, that's the big issue down here is that we have folks here that I know that would love to sell their current property, move into another one, but they got mortgages on it, and the rates are, like I said, in the low threes. And if they were to sell and move into a new property and renew now, they'd be probably looking at, low sixes. So that's part of the reason we're seeing a bit of a bottleneck in the real estate market here in the U.S.
Yeah,
All right, Peggy, let's move
it's good
on
and
to,
bad.
yeah, let's move on to question number three.
Mhm.
I'm planning to retire in the next 2 to 3 years, and my mortgage is now up for renewal. What should I consider as I look at this renewal?
This is where you want to work as a team with your financial planner, and the mortgage person, because working as a team, you can now start calculating where your income's going to be, what kind of payments, what's the importance of those payments at this point as well. Should we be looking at reducing those payments as low as possible to open up the cash flow, which is really good, spreading that amortization back? Because cash is king as you get closer to retirement.
Absolutely true there. I'll agree with you on
Yeah.
that one.
So you want to really say, okay, how am I sitting for retirement? Should I be taking that extra money instead of rushing to pay down my mortgage and putting it into investments and then continuing on with a smaller mortgage into your retirement where those investments kind of drip out and make those payments for you anyway. So it really works as a financial planning tool and a debt management strategy at that point, not just how fast can we pay this off with the last remaining years we've got to work with. That's really kind of an old way of thinking. Now it really is, if your rate of return on your investments is say 6 or 7 and your mortgage is only say 3 or 4, it doesn't make any sense to be paying it off as quickly. And there's better tax planning to do it with as well.
You and I are literally working on a case like that right now,
Yes.
of a client of mine who's in that same exact situation, almost like
Yeah.
to a T. Now, I
Yeah.
would I would start by saying that it's important to align the mortgage renewal with that retirement income source that you have, whether it be CPP, as in Canada should say Canada Pension Plan.
Yep.
No acronyms, Wayne. Canada Pension Plan, Old Age Security,
Mhm.
pension income, or if you have a registered retirement income fund, otherwise known as a RIF, they have to all be factored in, and not just for 1 year. When we do a capital forecast here, typically, Peggy, we look at a 20-year forecast. So for this person who's going into retirement, in this case, we would do a 20-year forecast looking at their what they're getting from Canada Pension Plan, what they're getting from Old Age Security, what the expected pension income they would be. Maybe they're on some kind of a defined benefit plan from their employer, and maybe they have a registered retirement income fund. And we know, beginning age 71, they're going to convert their, say, RSP to that registered retirement income fund. And we know there's going to be at least a minimum that they had to take out of that plan. So we're going to have a rough idea what the income sources will be for all of those. And then we can look at the mortgage payment and then their spending requirements. And that will help with helping you actually. If we give you all that data, will help you kind of tailor a mortgage plan that will work within that context. And also trying to keep the client's spending rate of their liquid assets within reason.
Absolutely. That's really important when you're talking about this. That's also a good way when you're doing that. If the plan is working great and everything's fine, because a lot of people have pensions from all sorts of different countries as well coming to Canada. So you could have pensions from the UK, you could be dual citizens in the States. All these different things change. So when you're doing that, keeping that cash flow and that strategy strong and updated is really important, because if the rate of exchanges change and your pensions have more value, you could start putting down extra money on your mortgage or things like that. But the prepayment privileges are there, can easily be used. But in most cases, at that point in time, you're better off to look at other options. And that goes into also people that are looking at retirement and they still have a very large mortgage, but not enough savings. And that, of course, comes up as well. Then do we look at reverse mortgages utilizing?
You took the words right out of my mouth. That was excellent. Yeah, that's a great
Yeah.
segue. I was going to bring that
Mhm.
up. Yeah, absolutely correct. Is that perhaps the reverse mortgage is the solution? One question I think most people would be interested in is in the value of the property. So let's say you have, I'm just make it simple, round numbers, $1 million property.
Mhm.
And let's say in this instance, just for simple math here, there is no mortgage.
Right.
But again, there's a cash flow need. What typically is the maximum when you're doing a reverse mortgage in Canada? What's the maximum amount that would qualify out of on $1 million property? Like what is it, 50%, 60%? What is it typical?
The maximum is 55%.
And it's
Um,
age dependent too, right?
It
You have
is
to.
age dependent, yeah. In most cases, it's not so much location as it's age dependent and home style and type. For instance, a condo would maybe not have the 55% because it's just not as, turnkey kind of thing if they need to sell it. A detached home will have up to 55%. It's great rates. They're not much higher than fixed rates, which is really good. And you can either get a lump sum and invest it, or you can actually get a monthly income from it as well. That money, just like some great investments, is non-taxable income. So it's a great source as well, so that you're not maxing out your Canada Pension Plan, your Old Age Security, any supplements, or taking investments from money out of your investments. But maybe if it's not good a year, you might want to look for a couple of years to offset that income structure. So there are some options there utilizing those
And
services.
and you have liquid assets that you're drawing from. It could be specifically, I have reverse mortgage friends down here in the U.S. They always say, well, you're having a really rough year in the stock market. Maybe tone down your distributions from your taxable investments, and in those years use the reverse mortgage as a way to make up the difference. So you're not selling shares at a major discount. So another
Yeah.
option.
It is, and there's 4 companies that are in Canada now that are offering those products. So it's not new and it's not, just a niche market from one company or whatever. There's 4 companies offering it, and like I said, the rates are not bad. Like they really aren't extravagant or anything. They can be paid off. Lien's the same as any property lien, whether it be a mortgage, reverse mortgage, line of credit. Actually, a line of credit is a collateral charge, meaning they take the
Right.
entire home. Um, it can be ported from one property to another. There's just a lot of good things, really low risk.
So I guess the same thing though is that the property that has the reverse mortgage on it, Peggy, and here in the US, you have to be living in that property. I would gather the same rules apply in Canada. You just can't put a reverse mortgage on a secondary property. It has to be a principal residence.
That's correct. Yeah. You can lien on more than one property. So for instance, if you had two properties or you have two, you have your main property and another property that maybe your children are living in or something, if it's under your name fully, you do what's called an inter alia, or maybe in the States, it's often called an umbrella mortgage, where it
Oh,
covers more than one property.
oh, really? Okay, so you're telling me that I'm thinking, remember, I lived in Ontario for quite a few years.
Yeah.
So let's just say your main residence is in, well, Bradford, Ontario, where I used to live. And
Mhm.
let's just say, hypothetically speaking, I had a cottage up in Honey Harbor where my in-laws used to live.
And I know where that is as well, of course.
Yeah, so you're telling me that you could in fact have a reverse mortgage on your principal residence and the cottage at the same time?
That's right, as long as it's both fully in your name and not a rental property or commercial property or anything like that. It can
Interesting.
be done, yeah.
Interesting. Interesting.
Mhm.
All right, Peggy. Well, based on what we've talked about today, and we've covered a lot, probably more than
Yes,
we
we
even
usually
planned.
do.
We
Yeah.
usually do. What would you tell our audience today is one practical step? Now, if you're a Canadian homeowner, you're facing a renewal, and you're this year, what is one practical step they could take right now in advance of renewing their mortgage this year?
Start early. That's the biggest advice I can give you right now. There's some really great competitive rates out there. And if it's a case where we look at your existing lender and what's available in the market, it might be a better time to get everything pre-approved and ready to go in advance when you're getting the lower rates locked in prior
And how
to your
early,
renewal.
how early can you be? Like how
You
far in
well,
advance?
you can easily start 6 months, and then I would say you can usually lock in at least 130 days in advance. So you're talking over 4 months that you can actually lock that rate in.
Interesting. Okay.
And if rates are going up or you're concerned, it's a good thing to do. Just
Uh,
remember it can go down and you will get the lower rates as well. You're not going to get pinned into a higher rate.
so for those who want to make sure that renewal fits into their overall retirement plan, and wealth plan, which is obviously something we do here with our I would say very detailed capital forecasting network that we do for our clients. In your view, what is the best step or next step they should be taking with that regard? If they're looking at retirement planning and factoring in wealth management, what would you recommend somebody do in that case?
I'd recommend that we work as a team in a strategy to say, okay, what is the actual income going to be that's realized? And also take into consideration the first year of transition. If they're looking at retirement, not all that pension turns the same day you quit. So there can be time, or there can be a situation where, say, you're retiring in, say, November, and you've already made a lot of money that year. You may want to really watch how that payments and that structure goes during that first couple of months into the new year. So you want to really watch how your cash flow is the first year of transition and for taxable reasons, and then make a smooth plan to look at what's best. Is it better to just in advance reduce your payments as much as possible, get the cash flow in the right places for the right time, and then we can always increase it. We can always increase those payments. That's not a problem. But just do the smallest amount you can get approved at, and then let the rest be a fluctuation.
Or give yourself as much cash flow as possible in advance is
That's right.
basically the strategy.
Yeah,
Okay.
prior to retirement, it's always cash is king.
Okay. Yeah. Big time always.
Mhm.
Okay, so for the folks that are watching us here, they can actually see under your screen your name, your contact information, phone
Mhm.
numbers, the whole nine yards. But we have a lot of folks listening in on Apple Podcasts, Spotify. They could be driving around in their car out for a walk, however it is. For those folks who can't see your contact information, can you tell us what is the best way for them to get a hold of you?
Email is very easy to get a hold of me anytime, any place you need to. Then I'm going to be able to pick it up, respond to your question. And that email is easy. It's Peggy at the at sign of course, homestrategy.ca. So
Right, so that's
Peggy at homestrategy.ca.
now you're licensed in multiple provinces in Canada, British Columbia, Alberta, Ontario. But
Mhm.
if you have, the client case that we're talking about is someone in Nova Scotia. So are you able to help and work with those cases as well in other provinces?
Absolutely. Yes. The only province I don't have clear access to is the province of Quebec. And that is only because their real estate regulations are different there for registering. I can put you in connection with someone, but the other provinces I have access to.
Peggy? once again. Exceeded my expectations. A lot of great information. Apologies for putting you on the spot with the Indigenous claims issue there, but I couldn't help myself. But you handled it very well.
Thank you.
So thanks again, and I can't wait to have you back on the podcast. And know we will. Peggy Shepard is a Langley, British Columbia-based mortgage broker with Invis. They are Canada's mortgage experts. And Peggy, thank you very much. Great to see you.
You're welcome. Bye for now.
Take care. I look forward to bringing you the Three Questions podcast, and I hope you find them educational and informative. Please consider liking this video and subscribing to our podcast and YouTube channels. And to receive a notification when our latest episode has been posted, please click on the notifications bell. Lastly, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and we'll see you soon.